It wasn't a supply chain glitch, it wasn't a sudden spike in industrial demand, it wasn't even the geopolitical friction. In the East, it was the inevitable mathematical collision between paper promises and physical reality. The data coming out of London is quiet, it is buried in technical reports, it is hidden behind the opacity of vaulting ledgers, but the arithmetic is merciless. 150 million ounces, that is the magnitude of the deficit, that is the hole in the balance sheet of the world's silver market, and it is not closing, it is widening. For decades the market has operated on a specific assumption, the assumption that there is always enough metal to cover the claims that the paper contract and the physical bar are interchangeable, that the vaults of the London Bullion Market Association are bottomless. History suggests otherwise. History shows us that when the ratio of claims to assets reaches a critical threshold, the illusion breaks. The price does not just rise, it resets. We are seeing the early tremors of a seismic revaluation, the kind of event that destroys the purchasing power of currency and transfers wealth to those who hold the physical asset. This is not a new phenomenon, it is a recurring historical cycle, a cycle that has destroyed empires and wiped out the savings of the unprepared. The pattern is unmistakable. It happened in Rome when the silver content of the denarius collapsed. It happened in the Spanish Empire when the influx of new money destroyed the old economy. It happened in Weimar Germany when the paper mark detached from reality, and now the indicators suggest we are approaching the terminal phase of our own monetary cycle. The target is $70, but price is just a symptom. The disease is the currency itself. To understand why London is running dry and why 2026 is the mathematical wall we are hurtling toward, we must look backward. We must examine the anatomy of a currency collapse. We must look at the moments in history when the silver ran out, because the only thing new is the date. The mechanics are eternal. The mechanism driving this crisis is not complex financial alchemy. It is simple, brutal arithmetic. Throughout history, every major civilization reaches a point of peak dominance where its ambitions exceed its resources. The cost of maintaining an empire, funding a welfare state, or fighting multi-front wars eventually outstrips the productive capacity of the economy too. When this gap opens, the ruling class faces a binary choice. They can impose austerity, cutting spending and raising taxes to balance the books, which is politically suicidal and often leads to revolution, or they can choose the monetary shortcut. They can debase the currency, they can print the difference, they can issue paper claims against metal that does not exist. The incentive is always to choose the shortcut. The payoff is immediate survival. The risk is pushed into the future, but the future always arrives. We are going to examine 3 specific historical case studies that prove this pattern is not a theory but a certainty. We will look at the Roman Empire, where the debasement of the silver denarius tracked perfectly with the decline of imperial power. 3. We will look at the Spanish Empire during the price revolution, where a flood of silver and debt created the first modern example of a resource curse and sovereign default. We will look at Weimar Germany to see exactly how a sophisticated industrial society reacts when the currency dies and the middle class is forced to flee into hard assets. In every single case, the sequence is identical. It begins with peak dominance, it moves to unsustainable costs, it triggers the chosen monetary shortcut. This leads to inflation and instability. The population then flees into hard assets, specifically land and precious metals. Finally, we see social fracture and a priced-out middle class. This is not about checking boxes in a history book. This is about understanding the physics of wealth. The 150 million ounce deficit in London is not an anomaly. It is the sounding of the alarm. The vaults are emptying because the smart money is exiting the paper system and taking delivery of the physical asset. They are doing this because they see the same pattern we are about to explore. They understand that when the music stops, the only thing that matters is what you can hold in your hand. The window to position yourself is closing. The supply crunch projected for 2026 is not a guess. It is based on mining yields, industrial consumption rates, and the accelerating depletion of above-ground stockpiles. Let us begin where the pattern first became clear. Let us go back to the ancient world, to the moment when the most powerful empire in history decided that the laws of economics did not apply to them. To understand the present crisis in the London silver market, we must understand the denarius. For the first 2 centuries of the Roman Empire, the silver denarius was the standard of value for the known world. It was a coin of high purity, roughly 98% silver, weighing about 3.5 grams. It was the dollar of its day. A soldier in the legions was paid in denarii for. A merchant in Antioch set his prices in denarii. A farmer in Gaul paid his taxes in denarii. The stability of the empire was built on the stability of this coin. As long as the coin was sound, trade flowed, the legions were loyal, and the Pax Romana held. But the costs of empire are relentless. By the time of Emperor Nero in the 1st century AD, the fiscal pressure was mounting. The empire had stopped expanding, which meant the influx of plunder had slowed, yet the costs of the military, the bureaucracy, and the grain dole for the citizens of Rome continued to rise. In the year 64 AD, a catastrophic fire devastated the city of Rome. The cost of rebuilding was astronomical. Nero faced a liquidity crisis. He needed millions of denarii to pay for the reconstruction and to keep the population from rioting, but the silver mines in Spain were not producing enough metal to mint the coins he needed. Nero made a decision that would change the course of history. He ordered the mint to reduce the weight of the denarius and to lower its silver purity from 98% to roughly 93%. On the surface, the change was barely noticeable. The new coins looked like the old coins. They had the emperor's face, they had the official stamp, but they contained less silver. This allowed Nero to mint more coins from the same amount of raw bullion. It was the ancient equivalent of quantitative easing. It was a magical solution. Suddenly the treasury had more money, the bills could be paid. The crisis was averted, but the incentive structure had changed. Once the precedent was set that the emperor could create money by lowering the quality of the coin, every subsequent ruler used the same tool. The incentive was irresistible. Whenever a crisis hit, a war on the frontier, a plague, a demand for higher wages from the army, the emperor would debase the currency a little more. Under Marcus Aurelius, the purity dropped to 79%. Under Septimius Severus in the late 2nd century, it fell to roughly 50%. Severus famously told his sons, "Enrich the soldiers and scorn all other men." He understood that his power rested on the army, and he paid them with debased coin. The population was not blind to this. Gresham's law took effect. Bad money drives out good. People hoarded the older, purer coins and spent the new, debased ones. The velocity of money accelerated as trust in the currency evaporated. Merchants demanded more coins for the same goods to compensate for the lower silver content. This is what we call inflation. It is not that the bread was becoming more valuable. It was that the denarius was becoming worthless. By the mid-3rd century, the situation had spiraled into total collapse. This period is known as the crisis of the 3rd century. The empire was torn apart by civil war, invasion, and plague. 6. The currency had been destroyed. The denarius was replaced by the Antoninianus, a double denarius that was essentially a copper coin with a thin wash of silver. By the reign of Gallienus in the 260s, the silver content was down to 5%. By the time of Claudius II Gothicus in 268 AD, it was barely 2%. The silver was gone. The currency was a lie. The social impact was devastating. The middle class was wiped out. Those who held their savings in cash saw their wealth evaporate. The soldiers, realizing they were being paid in worthless tokens, demanded higher and higher raises, fueling the cycle of debasement. But the most profound shift was the flight to hard assets. The wealthy elite, the senators, and the generals stopped holding currency. They moved their wealth into land. They retreated from the cities to their great rural estates, the latifundia. They became self-sufficient, detaching themselves from the trade networks and the monetary system of the empire. This was the beginning of feudalism. The complex commercial economy of Rome collapsed into a primitive agrarian society because the money could no longer be trusted. In the year 301 AD, Emperor Diocletian attempted to halt the chaos. He issued the edict on maximum prices. It was a massive bureaucratic effort to freeze the economy in place. The edict listed thousands of goods, from wheat and olive oil to lions for the arena, and the wages of a scribe set a maximum price for each. The penalty for violating the edict was death. Diocletian believed that he could command the economy to obey his will. He believed that the inflation was caused by greedy merchants, not by the debasement of the coinage. The result was exactly what economic law predicts. Goods disappeared from the markets. Merchants refused to sell at a loss. Farmers stopped bringing their produce to the cities. The black market exploded. The economy ground to a halt. A contemporary observer, Lactantius, wrote that blood was shed for the sake of trifles, and that nothing appeared for sale. The government had to abandon the edict. But the damage was done. The Roman economy never fully recovered. The trust was gone. The silver was gone. Just like Rome, the Spanish Empire found itself trapped by the seductive power of easy money and the harsh reality of economic law. The Spanish established a massive mining operation using indigenous labor and a new amalgamation process involving mercury to extract the metal at an industrial scale. 9. Between 1500 and 1650, roughly 16,000 tons of silver entered Europe through Spain. This influx of wealth should have made Spain the most prosperous nation on earth. It should have built a robust middle class and a dynamic industrial base. It did the opposite. The Spanish crown, led by the Habsburg monarchs like Charles V and Philip II, viewed this silver not as capital to be invested, but as income to be spent. The incentive was to project power. Spain embarked on a series of endless wars. They fought the French in Italy. They fought the Ottomans in the Mediterranean. They fought the Protestants in the Netherlands. They attempted to invade England. The cost of these conflicts was immense. Despite the rivers of silver flowing into Seville, the crown spent more than it earned. They borrowed heavily from German and Genoese bankers using future silver shipments as collateral. They were mortgaging the future to pay for the present. The influx of silver caused a phenomenon known as the price revolution. 11. The abundance of money chased a limited supply of goods. Prices in Spain skyrocketed. Spanish industry became uncompetitive because wages and costs were so high compared to the rest of Europe. It became cheaper to import goods from France or England than to produce them domestically. Spain became a hollow empire, exporting silver and importing everything else. The arithmetic eventually caught up with them. The costs of the empire and the interest on the debt outpaced the production of the mines. In 1557, Philip II, the most powerful man in the world, was forced to declare bankruptcy. It was the first sovereign default in modern history. The mines at Potosi were depleted. The treasure fleets were targeted by pirates and privateers. 13. But the Spanish state could not reduce its spending. When the silver stopped, the power of Spain evaporated. They had confused money with wealth. They believed that possessing the medium of exchange was the same as possessing productive capacity. It was a fatal error. The lesson of Spain is that a supply shock of money, even if it is real silver, acts just like a printing press. If it is not matched by production, it creates inflation, destroys domestic industry, and leads to a dependency that cannot be broken without a collapse. Just like Spain, the Weimar Republic in Germany would discover that when the state loses control of its budget, the destruction of the currency is the only path left open. The collapse of the German mark in the early 1920s is the definitive case study of hyperinflation in industrialized society. It provides the clearest roadmap for the psychological and social breakdown that accompanies the death of a currency. In 1914, before the First World War, the German mark was a solid currency backed by gold. It traded at roughly 4 marks to the US dollar. By 1923, the exchange rate would be 4 trillion marks to the dollar. 14. The journey between those two numbers is a lesson in the mechanics of insolvency. Germany emerged from the war defeated and burdened with massive reparations, payments imposed by the Treaty of Versailles. 15. The industrial heartland of the country was exhausted. The state was running a massive deficit. The reparations had to be paid in gold or foreign currency commodities that Germany did not have 16. To buy the foreign currency, the German government began to print marks. They sold these paper marks on the foreign exchange markets, driving down the value of their own currency to meet their obligations. The crisis accelerated in January 1923, when French and Belgian troops occupied the Ruhr district, Germany's industrial center, to seize coal payments by force. 17. The German government ordered a policy of passive resistance. They told the workers to strike. To support the striking workers and the idle factories, the government simply printed the wages. They were paying millions of people to produce nothing. The supply of goods collapsed just as the supply of money exploded. The result was the Katastrophenhaus, the catastrophe boom. The velocity of money went vertical. Workers were paid twice a day. A clerk would receive his morning wages and immediately rush to the shops to buy anything he could find: bread, shoes, coal. It didn't matter, because by the afternoon the prices would have doubled. A cup of coffee that cost 5,000 marks at 10 a.m. might cost 8,000 marks by 11 a.m. This was the flight into hard assets in its most desperate form. The population realized that the paper money was melting ice. They exchanged it for anything tangible. We have accounts of people buying pianos they couldn't play just to hold something that wasn't a paper. Farmers refused to sell their produce for marks. They demanded barter. A doctor might trade a medical consultation for a sack of potatoes or a silver spoon. The middle class was obliterated. The pensioners, the war widows, the professors, and the civil servants who lived on fixed incomes saw their life savings reduced to the value of a postage stamp. A lifetime of thrift was punished. A lifetime of debt was rewarded. Borrowers could pay off massive mortgage with the price of a single egg. This inversion of morality, where the prudent are destroyed and the reckless are enriched, tore the social fabric of Germany apart. It created a deep, simmering rage that would eventually find a political outlet. The chaos only ended in November 1923 with the introduction of the Rentenmark. This was a new currency, but unlike the old mark, it was not backed by promises. It was backed by a mortgage on the agricultural and industrial land of Germany. The government admitted that paper was worthless. Only the physical assets of the nation had value. They had to anchor the currency to the dirt to restore confidence. The pattern repeats in 7 distinct stages. 18. Stage 1 is sound money. The currency is backed by a tangible asset, usually gold or silver. 19. Budgets are generally balanced. The economy grows based on production and savings. 20. There is a correlation between effort and reward. Stage 2 is expansion. The society becomes successful, ambitions grow. The government begins to spend on public works, military adventures, or social programs. The metallic backing becomes a constraint. The government begins to loosen the link between the currency and the asset, often creating a mixed system where paper circulates alongside metal. Stage 3 is debt. The costs continue to rise. The government borrows heavily to fund its obligations. 21. The private sector also leverages up, assuming that the good times will last forever. The debt load begins to exceed the productive capacity of the economy, but it is masked by the apparent prosperity. Stage 4 is debasement. The debt burden becomes undeniable. The government faces the choice of default or inflation. They choose inflation. In the ancient world, they clipped the coin. 22. In the modern world, they lower interest rates, print money, and expand the central bank's balance sheet. They assure the public that this is a temporary measure, a policy tool to smooth out the business cycle. Stage 5 is inflation. The new money enters the system. At first, it creates a boom. Asset prices rise, the stock market soars, real estate values climb, everyone feels rich. But then the prices of consumer goods begin to creep up. The cost of living rises faster than wages. The public begins to notice that their money buys less. Stage 6 is the crack up. The psychology shifts. The public loses faith in the currency. They realize that the government has no plan to stop the printing. The velocity of money accelerates. There is a panic into hard assets. Gold, silver, land, art, commodities, capital flees the financial system and seeks safety in the physical world. The financial markets become volatile and disconnected from reality. Stage 7 is the reset. The currency collapses or is revalued. A new system is introduced, often backed by hard assets or enforced by draconian capital controls. Wealth is redistributed. The debts are wiped out either through default or by being inflated away. The cycle begins again. Just like in Rome, Spain, and Weimar, we are walking through these stages today. Current data suggest we are deep in stage 5 and transitioning into stage 6. The parallels are precise. The London Bullion Market Association, the LBMA, is the center of the global silver trade 23. It is the modern equivalent of the Roman Mint or the Spanish treasure fleet. And the data emerging from London indicates a systemic fracture. The headline number is 150 million ounces, that is the projected deficit for silver in the coming year, but the reality is more complex. The LBMA vaults officially hold a large quantity of silver. However, estimates range regarding how much of that silver is float, meaning available for sale. A significant percentage is held by exchange-traded funds, ETFs, and private family offices. This metal is encumbered. It is not for sale at current prices. Some analysts argue that the available float in London could be dangerously low, perhaps as little as a few months of supply. The demand side is driven by a force that did not exist in Rome or Weimar. The green energy transition 24. Solar panels require silver 25. Electric vehicles require silver 26. The physics of electricity conduction dictates that silver is the most efficient metal for these applications 27. Governments around the world have mandated a shift to these technologies. This is a legal compulsion to consume silver. The industrial demand is inelastic. A solar panel manufacturer cannot simply switch to copper without sacrificing efficiency. They must buy silver regardless of the price. On the supply side, we see the classic signs of stagnation. Mine production is flat or declining. The grade of ore being mined is falling, just as it did in Potosi. The easy silver has been found. New mines take 10 years to bring online. The supply cannot respond to the price signal in the short term. We are also seeing the flight to hard assets. Central banks are buying gold at a record pace 28. India is importing massive quantities of silver, draining the Western vaults 29. The smart money is positioning itself for the revaluation. They are taking delivery. They are removing the counterparty risk. 1. Interpretation is that the paper price of silver, the spot price, is being suppressed by the derivatives market. 30. The volume of paper silver traded on the COMEX and in London vastly exceeds the amount of physical metal that exists. 31. This is the naked short position. It works as long as investors are willing to accept cash settlements, but as the physical shortage bites industrial users and wealthy individuals are standing for delivery, they want the metal, not the cash. When the requests for delivery exceed the available stock, the paper market breaks. This is the short squeeze. The counterargument is that higher prices will unlock hidden supply. People will melt down their silverware and jewelry. This is true, but it only happens at much higher prices, at $25 or $30. The incentive is not there at $70. The scrap supply enters the market, but by then the revaluation has already occurred. The purchasing power of the currency has already shifted. The arithmetic is merciless. We have a structural deficit, inelastic demand, and a finite supply. 32. The constraints are tightening. History provides us with 3 potential outcomes. The order is fixed. First, we will see controlled decline. The authorities will attempt to manage the transition. They will use rhetoric, price controls, and perhaps taxes on windfall profits to discourage speculation. We are seeing this now with the discussion of CBDCs, central bank digital currencies, and increased surveillance of financial transactions. They will try to slow the velocity of money and keep the population in the paper system. Second, if control fails, we enter chaotic collapse. This is the Weimar scenario. The peg breaks. The price of silver and gold uncouples from the paper currency. We could see a limit-up situation where the markets are closed because the price is rising too fast to clear trades. Supply chains for silver-dependent goods, electronics, solar would fracture. 33. In 1968, the London gold pool collapsed under similar pressure when the market demanded more gold. Then the central banks were willing to sell. 34. The window closed overnight. Third, the reset and restructure. The dust settles. A new monetary standard is established. It might be a digital currency backed by a basket of commodities, or a revaluation of gold to a price that balances the global balance sheets. In the 1930s, the U.S. government confiscated gold and then revalued it from $2,067 to $3,500 an ounce. 35. This was a de facto default and a reset of the system. The only variable is timing and pain. The 150 million ounce gap is not a theory. It is a physical reality sitting in the vaults of London. The price of $70 is not a fantasy. It is a conservative estimate of where the equilibrium lies when the paper leverage is removed. By 2026, the supply crunch will likely be acute. The window to act is open, but it is not static. Subscribe to this channel. Educate yourself on the difference between paper claims and physical ownership. Build resilience into your personal supply chain. Watch the vault data, not the television.